Hey there, and welcome to this explainer. Let's just jump right in, shall we? Today we're exploring the hidden pipes of the global financial system. You know, when you pull out your phone to buy a few shares of a company, it feels super simple, right? You literally just tap a button and boom, the stock is yours. But on the other side of the market, there are these massive forces at work. We're talking about players with billions of dollars at their disposal, executing trades that literally shape the global economy. So we're going to break down the fundamental differences between institutional and retail investors. And honestly, more importantly, we'll look at how the sheer massive size of these market participants completely dictates the rules of the game.
To really wrap our heads around this, let's use a quick mental model: buying milk. A retail investor is basically like someone strolling into a corner store to grab a single carton of milk. You pick it up, pay for it, carry it home. And that purchase, it has absolutely zero impact on the global price of dairy. But an institutional investor, oh man, they're like a massive global supermarket chain. They aren't just buying one carton, they are buying millions of gallons directly from global dairy cooperatives. And because of that massive, mind-boggling scale, they need a completely different logistical network just to handle the delivery. I mean, they need fleets of refrigerated trucks, regional distribution warehouses, complex multi-year contracts, strict quality control, the whole shebang. The underlying product is exactly the same, but the mechanics of actually getting it, totally different worlds.
So here's our roadmap for today's explainer. First, cartons versus tankers. Second, the retail reality. Third, the institutional giants. Fourth, managing massive market impact. Fifth, operations and custody. And finally, number 6, the ecosystem of size.
All right, starting us off with Section 1, cartons versus tankers, understanding the scale of the market.
Look, while both a day trader and a pension fund manager are technically trading, they're honestly operating in completely different universes of scale, risk, and complexity. Retail pays the sticker price, but institutions, they negotiate private contracts. When an institution decides to invest, they're moving staggering amounts of capital. We're talking hundreds of millions of dollars in a single day, and this creates a really fascinating dynamic. If a retail investor buys 10 shares, the market doesn't even blink. But if an institution drops a massive buy order onto the open market, it instantly drains all the available shares at the current price, forcing the price higher and higher just to fill their order. So they don't just participate in the market, they are a gravitational force within it. Their very presence alters the supply and demand curve in real time. It's wild.
Moving on to Section 2, the retail reality, personal gain, and collective schemes. So retail investors are just everyday individual people, right? Investing for their own personal gain, maybe planning for a family or saving up for a house. But how do we actually access the market? Well, it generally happens in 2 ways. First, there's direct investment. And this is exactly what it sounds like, using a retail brokerage account to directly buy individual stocks, basically acting as your own portfolio manager. But the second method is incredibly common and forms a huge part of the global market: indirect investment. This is where retail investors pool their cash into collective investment schemes, like mutual funds. Think about the logistics of this for a second. If you only have, say, $1,000 to invest, buying shares in 50 different high-priced companies is pretty much impossible. But if a fund pools $1,000 from a million different people, suddenly they have $1 billion. This setup allows an investment manager to create a highly professional, diversified portfolio. It gives everyday folks fractional access to ultra-expensive assets and expert management they simply couldn't afford on their own.
Which brings us to Section 3, the institutional giants, the massive movers of the market.
Now these are the heavyweights. Institutional investors are massive organizations managing giant pools of money. And they generally fall into a few key categories, each with vastly different daily operations. First up, we have pension funds, whose main goal is matching decades of future liabilities with steady, reliable retirement income for millions of workers. Next, we have insurance companies. They're focused on managing massive pools of cash, so they're always ready to pay out sudden, large-scale claims. And finally, hedge funds, which deploy highly aggressive, fast-moving strategies to exploit tiny market inefficiencies and generate high returns for their clients. Because these players are executing trades that are just so incredibly large, they kind of hold all the cards. They get to dictate exactly which banks and brokers they work with, and they make those choices based on super strict metrics. Basically, they demand top-tier execution performance, meaning they want their trades done fast and cheap, along with absolutely flawless operational accuracy.
All right, Section 4, managing massive market impact, the challenge of scale.
Okay, I want you to imagine for a second that you're an institutional manager. You need to sell 10 million shares of a stock today. How on earth do you do it without completely crashing the price? Seriously, if you just dumped that massive block of shares onto the public exchange, the sheer supply would completely overwhelm buyer demand. Everyone would see this gigantic sell order hit the tape, panic would set in, and the price of the stock would plummet before you even finished executing your trade. You'd essentially be destroying your own profits just by trying to leave the building. It's the ultimate paradox of size, right? Your own weight can break the ice you're standing on. So, how is this actually pulled off?
Well, the secret sauce here lies with financial intermediaries, specifically interdealer brokers, or IDBs. These are highly specialized firms that act as a thick velvet curtain for the market's biggest players. They provide strict anonymity, allowing these massive institutions to move gigantic positions without the rest of the market knowing exactly who is behind the trade. This often involves executing trades in what are known as dark pools, which are basically private exchanges away from the public eye, or they use highly complex algorithms to slice a massive 10 million share order into thousands of tiny invisible pieces that are slowly fed into the market over hours or even days. So interdealer brokers are essentially the hidden pipes that prevent these massive market-moving block trades from creating sudden panic or extreme volatility for everyone else.
Let's dive into Section 5, Operations and Custody, the nitty-gritty behind the scenes.
Let's look at this operational reality like a tennis match, bouncing back and forth. On the retail side, the focus is entirely on volume. Brokerages are constantly dealing with client services, making sure individual statements, app interfaces, and tax documents are perfectly accurate for literally millions of tiny, separate accounts. But, whack, bounce over to the institutional side and the pressure completely shifts. The focus here is on strict trade confirmation and affirmation. Institutions demand that every single detail of a multi-million-dollar trade, down to the final cent, is perfectly matched and legally agreed upon by both parties, often on the exact same day the trade occurs. And why the massive rush? Because the risk profile is astronomically different. A retail error might upset one customer who bought 10 shares of a tech stock, but an institutional settlement failure? Oh boy. If a $500 million trade fails to process properly, that massive pile of cash either sits uninvested or worse, has to be borrowed overnight from a bank just to cover the gap. And that triggers massive interest penalties that compound daily. No thank you.
Because of these incredibly high financial stakes, the way assets are actually held is just entirely different. Now, a retail investor usually has their name directly on a company's share register. But institutions, they rely on a highly specific structural split, legal versus beneficial ownership. Think of it a bit like renting a house. The landlord holds the legal deed to the property, but the tenant holds the beneficial right to live inside it and use the space. In the finance world, legal ownership is handed over to specialized global custodians and nominee accounts. These are basically financial fortresses that hold the actual assets safely in digital ledgers and handle the tedious, everyday corporate actions, things like collecting dividends and processing voting rights. Meanwhile, the institution retains the beneficial ownership, meaning they keep all the actual economic rights and the financial returns. This crucial separation of powers is exactly what allows institutions to trade efficiently, rapidly, and safely on a massive global scale without getting bogged down in administration.
And that brings us to our final section, number 6, the ecosystem of size, why the market needs both. Now you might be wondering, if institutions are just so overwhelmingly big, do we even need retail investors? And the answer is absolutely yes. A healthy financial market requires both sides of this equation to function efficiently. Retail investors provide a vital, steady stream of individual participation. They're basically the continuous pulse of the market, offering real-time price discovery on a micro level as millions of individuals react to news, trends, and earnings reports. On the flip side, institutional investors provide the deep pools of global liquidity. They act as these massive, stabilizing reservoirs of capital that allow corporations to raise billions of dollars to build infrastructure, fund research, and ultimately grow the global economy.
It really all brings us back to our starting analogy. Whether it's a single carton of milk or a global supply chain, our job is to ensure the delivery happens exactly as promised. That right there is the ultimate goal of all global securities operations. Whether a system is managing the risk of a direct $50 retail brokerage account, or affirming a massive, highly complex block trade for a multi-billion-dollar hedge fund through a global custodian, the objective is exactly the same: protecting the integrity of the market for players of every single size.
So we've uncovered the hidden logistics that separate the corner store shopper from the global distributor in our financial markets. We've seen how scale completely dictates strategy, from dark pools to complex custodial relationships. But before we wrap up, I want to leave you with this to think about. In this perfectly balanced ecosystem of size, how does your participation shape the global liquidity pool?
The next time you tap buy on your phone, remember, you're now part of a massive hidden machine. Thank you so much for joining me for this explainer, and keep questioning how the mechanics of our world truly operate.